think I warned you about this the other day. And what I said was like, this is the chapter where people's brains get broken. Even though it's like later, you'll be like, I can't believe it seems so hard. But when it's new, it just seems hard because it's new. Okay. So recognize that there's two different ways people can do accounting. One's called an accrual basis of accounting, and the other is called a cash basis for accounting. What we've been introducing to you without really telling you is something called the accrual basis of accounting. So in the olden days, everybody just did accounting with the cash basis, which in essence means when you pay out cash, you record it as an expense. When you receive cash, you record it as a revenue. The problem with that way of accounting is that sometimes you do work for people, meaning you earn revenue before they pay you. In fact, it's pretty normal in business to give people 30 days to pay or 60 days to pay you. That's really normal. And also there's times when you have expenses that you maybe don't pay for right when you do it. Maybe someone delivers goods to you and they tell you can pay them in 30 days. Or sometimes the opposite happens where someone pays you in advance, but you haven't actually earned the revenue. That happens a lot in the storage business where people pay you for a whole year's worth of storage, but you really only earned 1 month's worth at a given time. And so the accrual basis of accounting tries to solve for that. Because what happens is this, is if you pay me for a year in advance of services and I record that all as revenue today, I'm going to have this big chunk of revenue on my records today and then no revenue for the rest of the year, even though I have the costs associated with providing that service to you over the rest of the year. And so it creates all sorts of problems. So accrual accounting is where we match our revenues with when we earn them, not necessarily when we receive money. And we match our expenses with when the term they use is incur. So when we I guess you'd say you earn the expense, so to speak. You receive the service or the goods or whatever, okay? So we match those up with the time period in which we either earn the revenue or incur the expense rather than when the cash changes hands, okay? But that creates its own set of issues, is how do we track this where I've received cash in advance and what is that cash and how do I deal with it? Or when I pay something in advance, how do I record that on my books? So, yeah.
I got a question about that. So you get paid for whatever services in advance.
Mm-hmm.
Is it only kind of like by month basis? Then you put that money into an account that would be interest.
Mm-hmm.
If so, you put that into your final yearly statement.
Right. Yeah, no, that's a good question. It's kind of exactly what we're going to get at today. So she says, if you get paid in advance, what do you, this is for the sake of the recording, this is unidirectional, they won't hear your question. If you get paid in advance, what do you do with that money? Do you have to put that money in a savings account so that it's safe and it's there? And then how do you record it and how do you deal with that, right? And so first of all, usually if I get paid in advance, that money just becomes part of my operating money. And so I don't put it into a separate account, but I have to record it. Think about this. If somebody pays you in advance, your cash goes up, but your revenue doesn't go up because you haven't earned the revenue yet. So instead you have to record it as something else, and you record it as a liability, it's called unearned revenue. And that one's confusing because it has revenue in its name, so everybody thinks it's a revenue, but unearned revenue is a liability. And why it's a liability is because I owe that person either the services I promised when they paid me in advance, or I owe them their money back, one or the other, right? And so this whole chapter is about how we deal with that, how we receive that cash and record that unearned revenue liability, and then over time, we start to record the revenue we've earned and reduce that liability as we earn it, okay? And so that's what this whole chapter is about, and it gets confusing sometimes because you're dealing in multiple time periods. So remember, a fundamental basis of accounting is that it's periodic, meaning we work in periods of time, usually a month or a quarter or a year. The most common you'll see is a month or a year, and then quarterly, that's 3 months, right? A lot of businesses work in quarters. So let's see if I can get this to work. All right. So the cash basis of accounting, where things don't match up, it's simpler in some ways, but it's actually not legal, I guess. It's not approved by in generally accepted accounting principles because cash doesn't match up with when you've earned it and so forth. So some very small businesses, like when you file your taxes as a really small, like a micro business, they'll allow you to use a cash basis, but it's because usually those businesses work in cash, right? They really do get revenue when they get cash and really do pay cash when they do their expenses. They're not doing, all sorts of crazy stuff. So I mentioned this. These are terms that you'll need to know. Use and the accrual basis of accounting, we use something called the revenue recognition principle. Okay, and what that means is revenues are recorded when they're earned, which means when the services are performed or when the products or goods are delivered. Okay, so that's when we record revenue. Even if we don't get paid now, but are going to get paid later, or even if we were paid in the past, we still don't record it as a revenue till we earn it. That's a really important principle. And then similarly, the expense recognition principle, expenses are incurred, must be reported in the same period as its related revenue. Okay, and they call that accounting, they call that the matching principle. So remember, all an expense is a cost. If you think about it, it's a cost of doing business. Another way of putting that is it's a cost of earning revenue. So we have to match our costs of earning revenue to the revenue we earn with it. Okay, so if I'm paying employees, the reason I pay employees is to work, and the reason they're working is to help customers, and the reason we're helping customers is because that's how we earn revenue, right? So we want to match their pay to the same time period in which we're getting the revenue for that, and that's the idea. So this whole chapter is on what's